A solid gap fill range in 2014 is contrasted with the descending triangle and failed flat bottom in 2015. The sustainable downtrend benefits from a moderate bullish retracement, starting from the 2016 double bottom. This is then contrasted with a relatively small double top that benefits from 2 consecutive gap downs that aren't immediately filled. The double bottom range has an expanded upper boundary due to the close proximity of the small upswing, larger red candles, and higher volume from mid to late June. Price action is neatly contained within the main double bottom outline for a pair of helpful trend lines. A solid recovery develops following a failed double top, ending with flatter movement to begin September after the normal neutral to bearish trading following the break of the double bottom's uptrend line. Here is a great example of declined double tops with extended lower boundaries due to past levels of significance in close proximity, like the 6410 and 7390 levels. The first one also factors in the small gap up. The 6410 area retains influence in December for a short time by resisting an uptrend. The second double top doesn't have a gap up before it, but has a large green candle before it, for a similar extended lower boundary in line with the old 7390 level. Though this ends up being less important, as the extended boundary is instantly breached, like the first double top, but with a gap acting like the large red candle in October. Similar to the last pair of double tops, this flatter double top also has a wider lower boundary due to a small gap up before its formation. Early 2020 was a bearish period, particularly for airline stocks like United Airlines. Towards May, there was plenty of focus on a descending triangle's development. The break of the triangle's trend line began June with the greater possibility of at least a minor uptrend after the descending triangle technically failed, with the bullish spike on May 26th. 3 methods rising price action accelerates into a short-term bullish overextension. Additional bearish advantage comes from the gap downfill and a general peak in the broader market during the same approximate time in early June. The uptrend into 2021 is more of a passive rise after a long-term bearish overextension. Selling pressure remains constant, and bullish volume remains relatively low during the slow climb. The failed descending triangle's ranges are highly valid since they run through many clear swing points from over a decade ago. Interestingly, there was price action neatly contained within a sharp head and shoulders outline, with the IPO price precisely marking the neckline. The neckline range didn't need to be expanded, because the gap up before it was not a small one and would have been too imprecise of an expansion compared to small gap ups seen earlier with double tops. Though it is interesting to see how a head and shoulders managed to accelerate the gap fill.